Oh man, so the Fed are about to crash the crypto markets. Yes, I think the Fed are about to not do something, but I think the market is going to lead itself to a Fed-induced market dip. And I'm going to explain my rationale, my thoughts around the longer-term economy over the next few weeks and months, and what I think is going to happen, what I'm positioning my portfolio to prepare for. So if you appreciate my perspectives, you want to know what I'm doing over these next few weeks in terms of macroeconomic policy and how that affects my crypto portfolio, make sure you hit up the like button. Make sure you subscribe. If you appreciate my perspective, check out the course member live streams, ijaz.uk/member. Right, so what we've got going on here, guys, is we need to zoom out and remind ourselves of what the macro picture is. And that is what I want to speak to you about today. Now, up until this point, we had many a false start in the market, right? We were expecting the market to run and then pull back. And we said that was perfectly normal because we knew that the market was worried about the first interest rate hike on 16th of March. Now, since then, Jerome Powell came out and he announced his first interest rate hike of 0.25% or 25 basis points. The market was okay with that, and we knew that would then set us up for a big move to the upside. We got that. We went as high as 48,000 on Bitcoin from our lows of about 33. So this was an impressive move to the upside on Bitcoin, but we've since got rejected. And we know we've just had a crazy week where the Fed has shaken the market, all through two key things. The first, earlier in the week, was two hawkish Fed governors came out and they said some hawkish tones, right? These are normally doves. You had Brainard and you had Marie Daly. They came out saying things along the lines of the economy is overheating and we may need more double rate hikes, right? 50 basis point hikes. We then had the Fed minutes, which came out again saying the market is looking strong, inflation is still very high, and we need to have more interest rate hikes. Now, the issue we have is we know the next meeting is on May the 4th, and we know that the market has actually priced a double rate hike in, right? If you head over to the Fed rate monitor tool, give it a quick refresh, and you will see 80% of participants has priced in a double rate hike, okay? So we know a double rate hike on its own cannot fear markets, but we also know that there's something else that the Fed want to address. And that is called balance sheet shrinkage. Or in other words, an easier way to talk about it is quantitative tightening. Okay, so when the pandemic came about, the government went ahead and did something called QE, or quantitative easing. That is when you print money into the economy to make things easier. You're loosening monetary policy. You're making it easier for businesses and people and consumers to access money. That is what kept the economy afloat through the pandemic. Now that we're coming out the other side, now that you have inflation moving, now that you have the labor market really improving, we got the jobless figure on Thursday showing beating expectations, showing the labor market's really healthy. That means that Jerome Powell and the Fed need to start tightening monetary policy, make it more difficult to access money. Now, what is his first tool for doing that? Interest rates. Okay? And we're seeing that. He's announced a plan to increase interest rates. He's increased it by the first, and we expect more increases, at least probably 7 this year. Okay? Now, the question is, if we just receive 7 0.25% interest rate hikes, that's one thing. The market's okay with that. If we see a couple of 0.5%, that is the question. How will the market react if there's 3 or 4 0.5% interest rate hikes this year? What if there's a 0.75% rate interest rate hike? How will the market react then? That will be a triple rate hike in one meeting. These are the things that can spook the market. And therefore, anytime we're leading up to a Fed meeting, you can see the calendar here of the scheduled Fed meetings. We got May, and we got June, and then we got July, and we got September. The market is going to have a little bit of a worry, right? Because they're going to be worried about what happens. So let's say in May, when we're heading up to May the 4th, this is what I'm preparing for. I'm expecting a sell-off leading up to May the 4th. I'm expecting people to get a little bit spooked. I'm expecting markets to kind of have a red week leading up to May the 4th in anticipation and fear, more importantly, that Jerome Powell may have a double rate hike. He may have a triple rate hike. More importantly, he may extend or have an aggressive quantitative tightening approach. Now let's spend a minute understanding what is this QT? What is this quantitative tightening? So we spoke about how money was printed in the economy. Quantitative tightening will take that money, think of a Hoover, take that money out of the economy. But that can be fairly jarring. you may remember from my previous videos, we use the analogy of a car. A car is speeding down the motorway, okay, and you want to stop this car. That's inflation. Okay, this car's speeding down the motorway. Now, your normal protocol is to use interest rates, right? It's to apply the brakes. Apply the brakes and slow the car down, but do it gently. Don't be that, weird driver that just kind of gives it that jerky motion on the brake and nobody wants to be a passenger, right? You're going to get whiplash. Okay, so you want to increase interest rates steadily. We know that. Anything like a sudden % increase in 1 month or a three interest rate hike will spook the markets. But then that's not enough. The car's still not slowing down fast enough. There's something ahead, right? We need the economy to slow down. It's a problem. So that is what quantitative tightening is doing. It's saying we're going to go and put like a parachute on the back of the car or have people at the front of the car like thrusters pushing the car backwards even more. Now, you've got to be really careful with that. Not only could you jar the economy by doing that, imagine the experience, right, for you in that car. Very unnatural way to slow a car down. But also, if you're not careful, what could you do? If you apply too much thrust, you could send the car off course. That is the fear of stagflation. That is the fear of recession. You can even send the car backwards down the motorway, right, if you apply enough force. That is recession. That is damaging the economy. This is something the Fed have to manage, and the market's going to be really spooked about this for at least the next 6 months. Okay, because look, they're going to see an interest rate hike. They saw the first one. They're like, okay, the economy's not doing too bad. They'll see another one. They'll be like, oh yeah, the economy's not doing too bad. They'll see earnings coming through from companies. They'll be like, oh, we're taking this in our stride. Labor market's still good. These interest rates aren't too bad. And then the market's going to come back risk on. So for me, macro term, I'm expecting the market to continue to be pretty bearish. Okay, particularly in the lead up to these meetings, we will see undertones of worry, of uncertainty. Remember, markets do not like uncertainty. They do not like the unknown. If investors can know the good and the bad and they have it written down, that's perfect. They can execute their trades. But they don't like uncertainty. And May the 4th is the next piece of uncertainty we have, and we have to pay attention to it. So in the lead up before then, and even up to the meeting on May the 4th, I expect red candlesticks. And these will potentially be really good buy the dip opportunities for us. In fact, let's go on over to our Bitcoin chart. Let's click on the daily chart, and we'll do this together. We'll go ahead and we'll put a vertical line in, and we'll go ahead and we'll put this right there on May the 4th. Okay, so we're going to wait to this day, and I'm expecting maybe we can have a rally before then. That's fine. Maybe this week can be a really good week. Okay, maybe the next 10 days could be a really good 10 days. Maybe we can run up, but I'm expecting a pullback. And remember, why are we saying that Bitcoin is following the economy? Because it is. If you track the correlation between Bitcoin and the Nasdaq and the S&P, it's super correlated. The correlation coefficient is very close to 1, showing an almost identical perfect correlation to the stock market, which makes complete sense because, as I've been saying for many, many months, Bitcoin is trading like a risk-on asset. It doesn't matter what's in the news right now. We saw the Jack Mallers announcement at the Bitcoin Miami conference. It didn't move the price whatsoever. The market cares about what the wider market. Crypto market is looking at the wider market. And so if you have a horrible day on the S&P and the Dow and the Nasdaq, Bitcoin is going to fall. It doesn't matter what's going on or if Do Kwon's buying or the other stuff. That all stuff is all good from a fundamental perspective, but that's not going to move the market day to day. The market is looking at the wider market because that is where Bitcoin is right now. It's a risk-on asset, and it will move in correlation to that. So that is what we're looking out for. That is my thesis and my plan over the next few weeks here. I won't be surprised if we see a little bit of a rally and then a pullback before the FOMC meeting, but I'm going to be using those opportunities. I'm going to be waiting for those moments when the market is fearful to position myself to do my purchasing. You won't see me chasing any green candles. I don't have green candle disease. Thankfully, I got myself checked last night. Don't have green candle disease, but I will be waiting for those pullbacks to accumulate on the coins which I want to pick up at a better cost basis. So there you have it, guys. If you appreciate my perspective, don't forget to hit up the like button and subscribe. If you want to hear more, consider joining our course member live streams. Those are 3 times a week live streams where our members get together. We have just a private group where we can chat, we can talk about the crypto markets, we can do tokenomics, we can look at TA for your favorite coins, take your portfolio, we can talk about the things like we've talked about in this video in terms of the macro economy and what I'm thinking about the wider macro market and much more. There you go. What I'm going to do the end of this video is I'm going to link up the video to the one crypto rule. Make sure you go watch that. If you like this video, you'll definitely like that video in terms of your perspective in how you're investing in the market. If you know this one rule, you're going to be set. Thanks for watching, guys. We'll see you in the next video.